radio for a really great future. We're talking real money.
Well, we're nearing normalcy. We're nearing podcast normalcy. Well, sort of. I mean, for me, when this show is being recorded, oh, by the way, hi, welcome to Talking Real Money. I'm Don with Tom. As this show is being recorded, I am sitting in the state capitol, well, actually across the river from the state capitol of South Dakota. I'll give you a minute. What's the name of the state capital? What town is the state capital of South Dakota? Most people.
And I want full credit for knowing it, by the way, without you prompting.
Knew it, but
yeah,
I
did.
Yeah.
I'm weird.
You're a geography history kind of guy.
That's true. That's true. Yeah.
But most people probably will have a difficult time coming up with a city in South Dakota. At all. I just found out that in the running for the because I like these kinds of weird facts. In the running for the city of South Dakota, or for the capital of South Dakota, Mitchell was the number one. It was the front runner.
That's where the Mitchell, the aviator?
Isn't that where the Corn Palace is? I think the Corn Palace.
I have no idea.
Huron.
Careful the way you say that.
Huron, which I went through, and I hardly noticed. And I think that was it. I think those
Yankton?
No, and you know why they picked? Ready? Here's the answer, everyone.
Please. Ding, ding,
Pierre, South Dakota. Yeah. Do you know why they picked Pierre? Basically,
because there's a lot of French people there.
Dead center in the state and on the banks of the Missouri River.
No, why did they pick it? Oh, that's because
it's dead center in the state and
has
on
a river.
The banks of the Missouri River. And in the 1800s, having a river was kind of important.
Yes, it is. It was. Yeah. Okay. Fair enough. So how's the place look?
Well, I'm at this RV park looking out over the Missouri River Valley, and it's a nice view. Yeah, it's great.
Yeah.
It's hot as Hades.
Yes. Welcome to the West.
So the AC's running, and I'm hoping the post-processing will take that out.
Yeah.
So welcome to Talking Real Money on the road. I'm Don on the road. Tom is in the Bellevue, Seattle studio. And we're here to help you deal with some of the money stuff that crops up from time to time. And one of the issues that is a big part of our collective problem with investing, our collective failure when it comes to investing, is this nasty trait of human beings, most human beings, not all, but most, to think we're special. We're unique. We're better than average. We deserve special investments. And the government has carved out, well, actually, in the 80s, they carved out a special class for all of you special wealthy investors. You're called an accredited investor. So, Tom, what is an accredited investor?
Yeah,
what is
it? The numbers were last updated when a guy named Ronald Reagan was in the White House, 1982.
So after inflation, you're less special?
You're not very special at all. Net worth of $1 million, excluding real estate, and income of $200,000 a year. Now, those are not very big numbers in the year 2024. Not really. I mean, they're
big numbers for people who make a lot less than that. That still sounds like a big number, but
it does.
And at the time, those numbers were huge. I mean, $1 million literally made you wealthy back then. Yeah. And today it makes you upper middle class or middle class.
That's exactly it. And which is fine. And again, do I think they should update these numbers? Absolutely. Do I think they should make it harder for people to get invested in some of these things? Absolutely. Because here are the top 10, by the way, for accredited investors. You ready? The top 10 investments.
No, I can't wait.
Private equity, number one.
Of course.
Private credit, number two.
Of course.
And then there's always, and by the way, if you like this category, you should come by my place because I'm trying to get rid of some of this. Fine art. Fine art is number three.
You don't have fine art.
I know. I have art, but it's not fine.
It's not fine. I've seen your art.
I know. Well, you won't see it when you visit next time.
It's a step above the roadside velvet Elvis.
I would not a big step, but it's a small
step above that.
Number 4, crypto. Gotta love that.
Golly.
Number 5, farmland. Number 6, commercial real estate.
You've got that too.
I do. I do have farmland, commercial real estate, wine, which, everybody should invest in wine. I would say to drink it, but not necessarily to hold it for a long period of time. Venture capital, and then bringing up the rear. And we have a question about this later. Hedge funds, which have fallen greatly out of favor.
Hedge funds have slipped to number 10.
Yeah, they're just not what they once were.
Maybe that's because
also,
of all of the press they got about not being able to beat the S&P 500.
We'll take that up in a couple of minutes here. The other one that I see not here, but maybe it's somewhere in here, is private placements, which used to be big. Right?
Private placements were huge. Yeah,
that was the real. That's a place that real money was made for the people that sold the private placements.
Do you know what all of these seem to have in common to me? Incredibly high levels of risk.
Yes, they do. And this is now more and more because the standard for, as you said, being an accredited investor has not changed in 50 years, 40 years, anyway, 50 years. That's giving more people access to riskier, less regulated investments.
42 years.
42 years. Thank you.
Don't make me older than I am.
Smart money has been going, like the pension funds, et cetera. And those thresholds should be changed. But let's talk about one specifically.
Can I interject there? There's one other thing I think that should be changed. This whole idea of saying because you have a bunch of money, you're a sophisticated investor is malarkey.
Thank you.
It is malarkey. It's baloney. It's BS. It is irrelevant. All it means is that you've got more for these investment firms to essentially take. That's what it means.
And I run into
there should
many
be
of you
testing. Honest to goodness, you should have to get a license as an accredited investor.
Show some basic understanding, because I run into a lot of people that have millions and they still own products that have big commissions on them, products that are very expensive.
And by taking the test,
active funds,
the accredited test, you could actually get a certificate that says you are officially a special person.
Oh,
so you wouldn't just be a special person, but you'd be an official. It would say you are officially special.
I have a certificate that says I can operate a boat on a lake, but now I can't figure out how to start the engine.
I think you should have your license pulled if you can't start the boat.
Can't figure out which button to push. But I think there's a pretty good recent example here of the trouble people can get in when they want to be special. And I'm talking about the Blackstone Real Estate Income Trust, which is something where, again, now anybody can buy into this. But the institutional money was investing in things like this, right? Private equity fund for wealthy individuals. That's what it was all about. It was special.
Right.
And started
supposedly
back in 2017.
safer.
Yeah, that's the joke, right? Because
that's the joke.
Yeah, I mean, it reached $70 billion in net asset value. That has fallen dramatically. Why? Well, because all these things they owned have fallen in value dramatically. And guess what else has happened? People have wanted their money back. And then they told them for a while, guess what?
You can't get it.
No, we can't do that. And this is the part that people forget about is being special means you can't get to your money sometimes because liquidity limitations on all of these things are big. We have stated this before, but I'll just say it again. I would prefer not to invest in anything where I can't get my money back right away and head to South America should the circumstances. I'm kidding. Not going to South America, but I want to be able to have access to my money.
I hate it when he does that because everybody's
it.
going, Tom's going to run off.
South
He's
America.
going to run off. Right?
He's going to run off.
If you're going to run off to someplace with extradition so we can come get you.
Well, even Venezuela, I'm told, is not that great anymore. They turned somebody over not long ago. But again, let's just talk this through a little bit. All these things we just mentioned, private equity, private credit, fine art, crypto, are they really giving you a greater return for the risk you're taking than in stocks and bonds?
No, they're not.
They're not. That's the thing. And so while
often
you might feel special,
perceived greater risk, particularly in non-publicly traded vehicles, because they can manipulate the numbers and make it look like there's more money there than there really is, because there is no daily or hourly or minute by minute marking to the market, as it's called.
Mark to market. Yes, it's different. Right. I concur. Number two, haven't you in the past made enough in publicly traded stocks and publicly traded bonds to, take care of yourself and your family for the future? In other words, did you need to be special?
I have an answer for that one.
Oh, okay. Yes.
I'm sorry. Average isn't good enough for me. I'm special.
You're one of those people.
I'm
okay.
sorry.
I'll make it the Vaseline out for your backside there. Make it all nice and shiny.
The regular people.
The little people.
Yeah, they can have the return of the market. I want more than the return of the market, sir. Sorry.
You deserve more. I'll put that out there right now.
Thanks.
Part 3 of this, if you go and look at the people that have been investing in these things, right? I mentioned this briefly, the endowments, the pensions, the smart money, and you look at how their return as a group has been compared to using index funds. Guess what? The index funds have outperformed them.
Yep.
So you can think you're special. You can really be part of the club, but do not go and buy these things. And more of them being sold every day because the numbers make sense for the people selling them. They make a lot more money on stuff like this than they do on the aforementioned index funds.
Yeah, and the fact of the matter is the only ones who consistently get richer on these products are the purveyors of these products, because the other thing that all of these have in common is that their fees are always, and I can say that I think without fear of contradiction, always higher than an index fund. I am confident that there is no accredited investment with lower fees than the Vanguard Total Market ETF.
Which is now what, like 10
possible.
basis points?
Yeah, it's just not possible.
Yeah.
So they charge more, they make money, but many, and you also have to remember that in many of these cases where people were considered to be special investors and made to feel special in a variety of ways, maybe beyond just the accreditation that the government talks about, they end up losing everything to some sort of convoluted Ponzi scheme even.
Yeah, you see that on a regular basis. So private companies, private equity, private credit, fine art, crypto,
you're never going to know. You're never going to know which is good and which is bad. You're never going to have the skill set to figure. You cannot probe through the various layers of thick onion skin that cover the inevitable hole in the middle of this investment, a black hole that sucks all your money in. Wow, that was a weird analogy, wasn't it?
That was a weird analogy. Capital, venture capital, and hedge funds, these are private placements. These are things you do not need in your portfolio and should ignore. Yeah,
skip them.
Very good
Skip
advice.
them.
Yeah. And let's get to a couple questions. This one comes from Ray in North Carolina. He writes, Dear Tom and Don, just read an article on CNBC. Hedge funds return just 5% in the first half of the year. And as you know, the S&P 500 was up like 15% in the first half of the year. And then he said, I thought these were the smartest guys in the room.
Mm-hmm. They are.
Oh.
Therein lies the problem. Even the smartest guys can't beat the market. So what makes you think you can? And they can't overcome the fees. They cannot overcome the fees. That's a big part of the problem.
You mentioned the bet with Warren Buffett over a decade where the hedge funds in aggregate, I think he had 10 of them.
It was an index. It was an index
underperformed. That's right.
Of hedge
underperformed
funds.
The S&P.
And he said at the end of 10 years, I'd be willing to bet that the S&P 500 will outperform your index of hedge funds. And the hedge fund guy, I can't even remember who it was, said, yeah, okay, put your money where your mouth is. They made a bet and Buffett won the bet. So if the S&P 500 exceeds the return of hedge funds in aggregate, what makes you think you're going to pick a mutual fund that's better, or that you're going to be a better stock picker than these professionals? They're failing.
Exactly. All right. Next question comes from Ted in Renton. When I convert, and I'm assuming he's not converting from like Catholicism to Buddhism, he's talking about converting individual retirement accounts to Roth, I'm guessing.
Given that this is a show called Talking Real Money and not Talking Real Religion, yes, okay. I think you're correct.
When I convert, do I need to take the entire IRA in a chosen brokerage, or can I do $100,000 a year with a hypothetical target of $1 million after 10 years? Maybe spread the $100K over 2 separate brokerages even. My hope is to reduce my RMD in the future. So can you do a partial conversion, or do you have to do the whole doggone thing?
You can do whatever you want.
Really?
You can remove
anything I want,
as much as you want or as little as you want. You can put it in 1,000 places or one. Why you would want to put it in 1,000 places, I don't know, but you could. So yeah, you got great flexibility. There's no rule that limits you as to how much you have to move in a given year.
I will add this. This is an area where I don't know if, how do I put this gently? I don't know that you should do this on your own. I think a professional should be.
Because there does have to be some tax planning involved.
Yep.
There really does, because often you think, well, I'm going to save on RMDs, but remember, you're paying taxes now. You're either going to pay it, which is going to be the greater hit to your bottom line, paying them now or paying them later.
And as you can remember, CPAs used to tell you pay no tax before it's time. So there's that. Of course, we don't know what tax rates are going to be after 2025. We don't know that. And here's the third part, Ted, that you got to know. Do you have the cash to pay the taxes? I do not recommend, as a sound practice, paying the tax from the IRA. In other words, shelling out part of that to
because then you lose tax advantage money going forward. You lose the growth of that money. If you're converting to a Roth, for example, you lose the ability for some of that money to grow tax-free for a very, very, very long time, which makes no sense.
Yeah. Okay. Third and final question for today. You ready?
Wow, it's a triple play.
This is a big one from Adam in Fairhope, Alabama. Well, you will not be traveling, I don't think, on your cross-country road trip.
I barely figured out from the Missouri River to Seattle. I've not figured out.
Make sure you slow down when you get to beautiful Lake Chelan so we can see you there.
I am going to stop there.
And by the way, speaking of our travels, very quickly before this last question, got a shout out to the fine folks in Madison, Wisconsin. What a great time we had there. And I had so many wonderful one-on-one meetings.
And I had just as good a time in Minneapolis as we did in Madison.
No, come on.
With the Stacking Benjamins people. But you know, they were all talking.
Money people
these
were
all talking real money people and Stacking Benjamins.
People. This was a dual meeting.
I'm telling you, they knew their stuff.
Okay, well done. But thank you very much for the great turnout, and I loved it. So Adam from Fairhope writes, I'm considering a career change with the ultimate goal of being a fiduciary located in my hometown. Unfortunately, there appear to be no financial management companies within 100 miles of my location that have a fiduciary on staff. Do you have any advice for the best path for reaching this goal? Don.
I would, you could do is there are firms called TAMPs that you can, as an individual, have them manage your back office, take care of the compliance and the trades and all those things. And they get a percentage of the fees you charge your clients. We have worked
out on your own is what
with
you're
a couple
saying.
of those. We worked with Buckingham when we were younger.
Yes, we did.
And of course, at one point, part of Appella was Symmetry, which was another TAMP. So you could go out on your own and be the only game in town.
And I think, by the way, here's what I would do. I would go get my Series 65.
Right.
Not that hard. License, you can go online. Yep. That allows you to give advice and charge for it.
Mm-hmm.
I would go get registered, as Don said, as a sole proprietor, whatever it is.
And you only have to register initially with your state.
Correct.
Well, and
state of Alabama. Yeah. But I would do that. But here's why. Because it's going to be, even if you're in a town with a lot of firms that are 100% fiduciary, it's going to be hard for you to walk in the door and get a job.
Right.
Because they're going to say, what have you done?
A 65.
But even after you have the 65, you may have to start, processing forms or doing something else. If you go the other approach, learn how to be a planner and give people advice, hang out your own shingle. I think that's the easiest route in today's world. If you don't have any experience, it's going to be hard otherwise to do it.
And it's going to be hard. It's like with every other business, you are not going to make a lot of money for a very long time. We can attest to that, too.
Yes, we had a few years where we did not make much money. That is true.
Yeah.
Okay, so any money. All right, any money.
And to find a firm that'll hire you, as Tom said, often, unless you've had experience, they don't want a new advisor, but they will take somebody as an assistant or associate advisor,
Exactly.
or someone who answers the phones and takes care of trades or whatever it is, to learn the ropes. So it may be a good idea. You might, once you get if you get if you're studying and you get a 65 and you go take the CFP coursework, you might find yourself in a better opportunity.
That's a whole different. Yeah. If you get
a lot
the
more
CFP,
work, do the coursework.
Yeah. That could help. All right. Couple things coming up you need to be aware of. Yeah. I will be in Portland on the 20th of September. Love to see you. That's Portland, Oregon. If you'd like to have a meeting with myself.
Although in the fall, he may go to Maine if enough people from Portland, Maine call him while he's in Connecticut.
It's a beautiful place, I'm told.
Oh, it is.
Simply go to talkingrealmoney.com, pardon me, and click on Meet an Advisor. Say, want to meet Tom in Portland, glad to do it. Don and I will be on the aforementioned East Coast on the 18th of October for Retire Meet East. You can go to retiremeet.com to register for that. And if you don't want to come and see us in person in beautiful West Hartford, Connecticut, you can register for the online. It's a little different than what we do in the first quarter out here in Bellevue. So take advantage of those things. And as Don says, ask for help. I've had so many chats the last 2 weeks with people and just said, go buy this, don't do this, and fixed people up. I've loved it.
For free.
I know. Go to talkingrealmoney.com, click on Meet an Advisor, and we will help you no matter what. So take advantage of those things.
Yep. All right. Thank you all so much. I am getting ready to hit the road in my silver trailer, heading from Pierre, South Dakota.
Yes.
We move west to Deadwood. We're going to Deadwood.
Great spot. Been there. Love that.
The spirit of Calamity Jane and Wild Bill Hickok live
there you go.
In Deadwood.
Make sure you sit against the wall when you're doing your gambling.
The whole time I'm there, I'm going to talk like this.
I would.
In Deadwood.
I'd have a big black hat on and not much cash.
In Deadwood.
Yeah, because otherwise it could be real trouble. Yeah.
I should get a job. I should get a voice job there. Don't you think I should do a Deadwood ad?
I do. And I love the show. So yes, I think you should.
All right, everybody. Thank you all for being there. We truly appreciate you and ask you to do us one big giant favor. Just tell one other person about the podcast. Get them to listen, because literally we can never have too many listeners to our podcast, because we're among the very few people out there trying to help you make more money, save it better, invest it better, because all we do is hang out talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.